I don't know, as humans, we always want the kind of immediate mirror in the past of whatever's happening today. And
Yeah.
sometimes on a smaller level, there is like a direct parallel, but there's just I mean, I hate the phrase now because I've heard it so many times, but the history doesn't repeat, but it often rhymes. Like there's nothing that's ever exactly the same. And so I can't think of a period that's exactly like today just because there's so much going on and there's so many different variables.
Hi, Jamie. Great to have you back on Real Vision.
Great to be here. Thanks for having me.
So we really wanted to catch up with you right now because so many people are trying to look to the past as they figure out what's happening with the economy right now. So we're just curious, is there a period in history that mirrors what's happening right now as you look across, all of the things that you study?
I think generally it's a question I get a lot, and I always disappoint with the answer because I feel like, I don't know, as humans, we always want the kind of immediate mirror in the past of whatever's happening today. And
Yeah.
sometimes on a smaller level, there is like a direct parallel, but there's just I mean, I hate the phrase now because I've heard it so many times, but the history doesn't repeat, but it often rhymes. Like there's nothing that's ever exactly the same. And so I can't think of a period that's exactly like today just because there's so much going on and there's so many different variables.
Yeah, but you hit on a great point. We want the answer, right? We want to know the outcome. We want to say,
Yeah.
"Oh yeah, this happened before and this is what the result is," which,
Yeah.
as you say, is probably unrealistic. But what are some of the what are some of the sort of, you know, periods that, while not exactly the same, like what would you look at, especially coming out of this pandemic? I feel like people are trying to figure out, are things completely different and it's a complete break with the past, or are there similarities?
So a few things that I would say is first, there is a period that I've been reading about recently, and a frequent Real Vision guest and sometimes host, Jim Grant, has written a great book on it that I need to now order. But I've been reading about the 1920, 1921 recession, which is interesting because there are a lot of differences between that period and today, but there are also some interesting similarities just generally with that kind of post World War One, or actually even during World War One and following couple years and maybe hopefully a decade, because then we would have a similar roaring 20s. But in that period, obviously World War One, 1914 to 1918, and then in 1918 you have the Spanish flu, which
Mm.
again is very different than COVID, but and isn't really even the Spanish flu, as I think most people now know. But it was a pandemic nonetheless, and it wrapped up in 1918. And then following that, in 1919, you had what was known as the Red Scare, which was this summer of racially kind of motivated riots across America around like race relations and some high profile cases of police brutality against African Americans. And so, again, something we saw coming out of pandemic. So that cycle was going. And then now, after the pandemic is nearing the end, hopefully, we also are experiencing a recession, which is, again, something that happened in 1920, 1921, and we're currently in 2022 and technically in a recession. And so what's interesting about that 1920 recession, though, is that nobody really talks about it because it was obviously overshadowed by a much larger depression 9 years later.
Mm.
And so everybody kind of forgets about it. But it's an interesting example, especially today, just because of the parallels that I mentioned, but also if we keep following this kind of trend, it'd be interesting to see whether this short recession now, if it is going to be short, then leads to a similar decade of prosperity, like the Roaring Twenties in that period. But we'll see what happens. But it's an interesting example because it's very different to what kind of monetary policy and Fed policy is today, because it lasted 18 months and the economy was very different. And a lot of the reasons for the initial fall were related to the collapsing price of cotton and other agricultural exports and commodities post World War One, because the demand wasn't there anymore. But
Mm.
the Fed during that period, you have to remember the Fed was only founded in 1913. And so at that point, The Federal Reserve Act actually didn't give the Fed any powers for acting as a lender of last resort. And so when they were faced with this severe downturn in 1920, it was kind of like the first true test for the Fed in a real panic and real recession. And instead of doing what we would now expect the Fed to do and lower rates and provide, more stimulus and cash and very kind of dovish policy, the Fed actually hiked rates in November 1919. Their discount rate was something like 4%. And then by January 2020, they had hiked it to like 7%, even as the economy was like tanking. Recession overall, unemployment reached 12%, and inflation averaged in 1918. I think inflation was at 18%. And in 1919, it was 14%. 1920 is 15.5%. But then in 1921, prices fell 10%. And between 1920 and 1922, there was deflation of like 23%. And so it was, instead of stepping in, though, the government and the Fed kept rates high because at that time, the view was we have to purge the rottenness, I think was the expression that the Fed used. And so instead of today, where it'd be like we saw during the pandemic, where rates are slashed and there's a bunch of kind of easing and stimulus provided, it was let them fail kind of mentality. And the government actually cut spending 75% over the 2 years of this recession, instead of, again, coming in and supporting the economy more. And it's been used as a kind of example for especially the libertarian crowd of how that type of approach can work because the market corrects itself. Because again, within 18 months, the economy rebounded, and then we had the roaring 20s. I feel like it's probably more of a one-off than an
Plus, there's never
example
any
of
discussion
what
of the
works.
collateral damage that comes with
Yeah,
the
exactly.
wreckage of what the cost of that is kind of always conveniently forgotten. But it's a really
Exactly.
interesting, it is a really interesting time to think about, because although, as you said, there are many things that will be different. I mean, a couple of things you said to me really jumped out, which is that the Fed was raising rates into that downturn, completely different reasons, but we do, even with all they know. And, let's remember Ben Bernanke, who a lot of, you can, however you feel about him, he was a student of what they did wrong in the Depression, right? And that informed a lot of what he did in the great financial crisis. Some people would say, sowed the seeds of the sort of bubble of cheap money that we have. But again, like the cost risk analysis at the time, he based a lot of his decisions, and collectively the Fed did, on their own history. But they were raising rates into it, which they're doing now. You had inflation, which was so high, turned tail quickly, which is a big issue, a big debate right now, whether that's even physically possible. And you have the resulting roaring 20s, which I don't think anybody has on their radar right now. I mean, you hear everyone talking about a recession, how deep will it be, how painful, and a lot of people wondering, is it going to be protracted, prolonged? Is it this sort of like we move sideways? And there's a lot of bearishness out there. You don't hear anyone saying once this is over, it's going to be this fantastic time of great prosperity. I don't hear anyone talking about that. Do you?
No, but it is funny with kind of human nature and just like our approach to things, because last year I feel like everybody was talking about a roaring 20s coming, and then this summer it's now everyone's bearish and like, how bad is it going to get? And it's just
We have
funny how
recency bias,
things
right?
can switch like that.
So yeah, we do swing in and out of that, bullish and bearishness, I think, right now, depending on where we just were. But I'm curious, do you think that it is so different now coming out of the pandemic? Do you buy some of the arguments that things are fundamentally different now, that, like life is forever altered post-pandemic, that it's a line in the sand?
No, I definitely don't. I think there are some things that will obviously change, but they'll be on a smaller scale long term. But I do remember people at the beginning of the pandemic, like, I don't know, April and May of 2020, tweeting just these outlandish takes. I think I posted that people were predicting post-COVID life with the accuracy of like 1980s movies of what 2020 would be like, where, everything's like flying cars, and we definitely don't have those today. And so people making these predictions of what life is going to be like. I mean, people were saying that just business travel was dead, period. Like nobody would ever travel again.
Yeah.
And all these things where some of that, again, it's like somewhere in the between, but way closer to what the previous paradigm was. And so, yeah, business travel will probably be less than it was for the next couple of years. But just to say, like, it's dead overall. Conferences are dead. I'm going to a conference next week. So I think that kind of talk is not realistic, but I do think some things will change. And in terms of historical parallels, the one that I find interesting is I think remote work long term will have an interesting impact on the economy because obviously that's a huge contentious debate over whether there are downsides or whether it really matters, and how long companies will actually kind of abide by this work from home mentality. I saw Goldman Sachs this week kind of said we're going back full 5 days a week
whether
now.
people do it or not is, I think, the big question, right?
Yeah, but during the early 20th century, after the kind of explosion in automobiles, Henry Ford's 1908 Model T and everything after that, for the first time, that kind of enabled the average worker to grow it allowed the average worker to move outside of just the immediate spot where they worked, because suddenly they could commute, which wasn't really a thing before. And it led to, I mean, suburbs were a direct result of the automobile, because you could live in a nice community, but still drive in to work. You didn't have to live directly near a train station that could take you to work. And so people spread out across America. And instead of having just a few major hubs, then you started to have a proliferation of smaller, like semi-hubs. But the economy broadened as a result because people could just travel, and it led to new industries like retail stores like Sears, and big department stores like that were totally enabled and really the result of the automobile, because you could have malls and retail centers that people could drive to. And so I think that the advent of remote work because of the pandemic will have, I mean, we're already seeing it, will have a similar effect, because this technology has allowed people to keep their job in a major hub like New York or San Francisco. And if they're at a company that no longer cares about having their employees in the office every day or a couple of days a week and are more flexible, suddenly these kind of knowledge workers can spread out across America and go into smaller hubs and kind of build their own communities there. And so eventually you get these kind of hives of innovation in other parts of America instead of just the San Franciscos, the New Yorks, et cetera. And so I think that's an interesting parallel. And I think we're already starting to see some of that play out. And I think that'll be one of the lasting effects. It's just to what degree the work from home kind of paradigm continues.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
I think that's fascinating, and you know, an optimistic, sort of maybe a silver lining out of this, because it's sort of labor mobility amped up, and that's always been a powerful economic driver. You know, the fact that Americans would pick up and move, which doesn't happen other places, has always been, you know, positive for GDP. So that's really interesting. So what about our, you know, when we look at the market, you just said something super interesting, which was like, you know, we can't imagine, from where I'm sitting right now, and maybe I'm experiencing recency bias because we have a lot of negative news out there right now. It seems like no one's talking about the roaring 20s, but you just pointed out, you know, at the sort of peak of crypto and NFTs, sure, like there are a lot of people who are imagining, you know, a super optimistic future. So obviously psychology really factors into a lot of this. And I was really interested to read one of your recent posts, We Just Can't Help It. And you talk a lot about that sort of psychology, how it impacts our ability to make decisions and the anticipation. I don't know if you can call it anticipation bias, but we seem to fall victim to that. Talk to me a little bit about that.
Yeah, and I just want to make clear that I obviously fall victim to these biases as well. So this is not just I study history, so I don't fall I don't succumb to any of these biases. But it's just I think history provides you with so many examples of these types of things that you become I don't know, it's kind of easier to identify it not only in yourself but just overall, because you just read so many examples in history of people saying like this time is different or this new innovation will change everything, and then it doesn't. I mean, it might have a big impact, but more times than not, it's not as revolutionary as people at the time think it is. And so in terms of the kind of media and our kind of affinity for making predictions and overreacting in anticipation of event, again, I think it was the Pascal quote where it's like all of mankind's problems derive from man's inability to sit quietly in a room or something like that.
Yeah.
I botched the expression, but basically we just can't not do something. And so especially when there's so much coverage and just obsession with things like Fed decisions and like rate hikes and what the CPI readings will be each month, there's so much anticipation of what the event will be that it leads to just like these wild swings because people start panicking because they're just reading into what's going to happen, every sentence that a Fed official says and how that could be interpreted. And it's just, you end up making these decisions because you think, oh, well, this is going to happen because he said this, and and this I bet will happen because this person says this, and you just like do all this kind of mentally exhausting backflips, and then you just lead to overtrading, which ideally for the average kind of investor, you are holding stocks and assets that you have enough conviction in that one kind of Fed hike or CPI reading isn't going to, make you sell your investment because you believe in it long term, and that's not your thesis doesn't go out the window if the Fed hikes 75 bips instead of 50. But yeah, that sense of anticipation and not knowing. I think the analogy I used in my article was when someone texts you like, "We need to talk," and then you don't hear from them for hours and you're just like, what about what? Like what happened? And then 9 times out of 10, it's nothing to worry about. It's not a big deal. It might not even be related to you, but that just
is there a bearish kind of bias to that anticipatory, like, oh, I'm anticipating and it's going to be worse than I think, I have to somehow protect myself. Is it sort of that?
I think so. Yeah. I think because I feel like it's more usually related to like an anxiousness, and there's rarely excited anxiousness. I feel like it's anxious anxiety, and people usually are worried about something if it's anxiety. And so, yeah, I definitely think there's a bearish tint to that kind of anticipation and the actions that that anticipation leads to.
Yeah, one of our frequent guests, Jared Dillian, says that he likes to say there's a lot of doom porn out there. There's a lot of people predicting the end of the world, basically, where that things are going to be really bad and here's what you need to do. But there's a prescription at the end of that.
Yeah. And I can see how people fall into that trap just from writing a newsletter for a couple of years now, where during the pandemic, especially, I mean, the first post I wrote, like just pandemics and markets was the title. And that got like an unbelievable amount of page views because it's at a time where people were just freaking out and they wanted any historical context on how markets and assets performed during pandemics.
This is your post on Investor Amnesia, correct?
Yeah. Sorry. And this was, I think, in March 2020. So obviously a time where people wanted historical context. But since then, I've noticed that just whenever the market's doing badly, that is when traffic to articles that I write related to markets doing poorly do well, because more people are looking for that. And so I can totally see why this type of, doom porn, to use his term, kind of exists, because there's this feedback loop of, if you're just constantly having these bearish takes we all know the people who are just constantly saying that the market's about to collapse 80%, and they just repeatedly for years and years and years and years say it.
Yeah.
There's a crowd for that, and people for whatever reason, I think there's been research done on this, like tend to view people that have bearish takes as like, it sounds more intelligent because it's like against the crowd. Whereas if someone's just saying positive things about the market and just everything's bullish, etc., it seems like, I don't know, almost just foolish optimism.
Yeah, there's probably some deep-seated need to protect ourselves that makes us want to pay attention to basically it's what the entire news business is based on, right? It's just
fear sells.
Yeah, fear, right. And it's and we all perk up and listen because we want to try to get a front run on protecting ourselves. I'm sure it's super primal, People always say, like, when the saber-tooth was chasing you down the road and there was a cave, if you knew where the cave was, you'd be the one who survived. So I think that probably we all fall victim to that. I mean, complete full disclosure is probably why we reached out to you right now, right? Like, Jamie, are there any historical it's the first thing I asked you. So we're all feeling that. So the other article that I thought was really relevant right now was you did something on the drivers of market returns and how they've evolved. And I thought this was really interesting because even amid all of the sort of, concern and doom and worry about inflation and recession and are the markets going to retest their lows, in the summer we saw this little resurgence of the meme stocks come back. And, there's that sort of pull to trying to find that big trade and jump on it. What do we need to understand about the history of how we evaluate these things and what kind of, what drives market returns?
So I wrote that paper. So I work at O'Shaughnessy Asset Management, and I wrote that paper for our firm. And I started writing it during the period when tech stocks were really just plummeting, and there were the seemingly endless announcements from VC-funded companies and startups about layoffs, et cetera, and valuations getting slashed, and basically just anything tech-related having a tough time. And a lot of these companies, it seemed like inevitable almost. I can't remember exact stat I saw the other day, but I think it was Bird or one of the scooter companies at some point had a valuation of like 2.5 billion. And now it's publicly traded and it's like a penny stock. And this was like just 2 years ago. And some of these just seemed they had way too many employees, and like it was just all in this optimism kind of cycle where a lot of the companies are good companies, but it's just the valuations that they were commanding were just so excessive. And it worked for a long time because there was this tech fueled bull market, and everybody's just focused on growth. But what I focused on in the paper is that a lot of these companies were unprofitable, and they had great narratives about the future and how everything was going to be disrupted. Whenever they were doing was going to be the thing that like changes humanity forever. That's obviously hyperbole, but
in some cases not though.
Yeah, in some cases not as much. But there was a quote I found from a article in 1919. It's actually from a book that was published called Simple Principles of Investment. And so it was more than 100 years ago. And I think the author summed it up perfectly. He joked that if there is nothing to compare, then there is nothing to criticize. And so for all these companies that are unprofitable and have great narratives, it's kind of this perfect gray area for them to be able to continue raising capital and attract investors, because it's kind of like a Schrodinger's box where there could be like they could fulfill every single one of these, projections and narratives that they're putting out there. They can nail all of them, or they could not. And because they're so early and they're not profitable yet, and they're not a full business yet, it's kind of hard to say whether or not they can do it because there's so little, especially if a company is unprofitable, to base off. And so that kind of gray area allows them to continue succeeding for a while. But the problem with that is, which we then saw this year, is that if people stop liking the narrative or just stop believing that they can do it, then that valuation and the company's performance, at least in the short term, is incredibly damaged, because a lot of the success in terms of raising capital and valuations and getting higher valuations is based off of convincing their investors that they will fulfill these projections, et cetera. And that happens in obviously the public markets too. And so historically, the paper I looked at was, or the data I looked at was comparing the sources of returns, kind of historically going back to 1870 versus what they've been in the last 10 years. And so so there's data from Robert Shiller breaking down the sources of returns for the Standard & Poor's composite since 1871 through 2021. And he breaks it down into the sources of returns, the total return in that period from earnings growth, multiple expansion, and dividends. And what's interesting is that from 1871 to 2021, multiple expansion only accounted for 6% of the index's total return. And multiple expansion is just investors' willingness to pay more money for every $1 in earnings. So that is kind of the proxy for that kind of narrative
Froth,
and
basically.
Excitement. Yeah.
Yeah. Or speculation.
The higher, yeah. And so historically, that's just been 6% in terms of the source of return in the overall index's total return. But over the last decade, from 2011 to 2021, multiple expansion accounted for 24% of the index's return. And if you break it out further into like on a sector basis, you can see that sectors like information technology is much higher for that multiple expansion source of return, because that tends to be the sector where we see the most disruptive narratives and kind of innovation, because I mean, that's where a lot of the innovation is occurring, but you see also a lot more froth there. And then a similar pattern emerged when we used our own data source, our own research library at O'Shaughnessy Asset Management, where we broke it out a bit further and across a different time period. From 1963 to 2022, there was a 0%, it was just flat contribution from multiple expansion to the US large cap index return. So it literally had no impact on the total return. And again, in the last 10 years, that figure was 27% for multiple expansion. So again, it just lines up with this kind of tech-fueled bull market that went on for so long and the role that narrative is playing. And that's great, again, when it's working and people are bullish and optimistic and things are going smoothly. But when things happen like interest rates rise and then the kind of sentiment changes and suddenly people actually want to see their companies they're holding be profitable, then that multiple expansion, if the point of the article is that if the companies you're investing in are getting a significant source of their overall market return from multiple expansion, then that is a fragile spot to be in if things go south, because, you know, companies' earnings aren't going to change on a dime, like by and large. Something, you know, major would have to happen, but investors' willingness to pay higher multiples for the same amount of earnings and the same stock, that can change on a dime, because that's just based on investors' sentiment. And so if a outsized portion of your returns are generated from basically investor sentiment and frothiness, then you are in a precarious position, because when sentiment changes like it did, at least temporarily earlier this year in both the private and public markets, then you see the result, which is a lot of these companies struggle.
Yeah. And so how that I think that's such a critical point. So it's the curse of Amazon and Google, though, right? Like people who were early investors in that, and they lost money for a long time, Amazon, and then it became this behemoth. And so with, you know, everybody kind of wants to recreate that, right?
Yeah. And again, to that point, that kind of approach from the companies today and back in the day is not a new approach. Again, I think, this is again from that book written in 1919. The author wrote about how, you know, basically why would someone invest in these new speculative enterprises, like essentially IPOs, when there's so much evidence that they don't succeed? So this obviously isn't a direct parallel today, but just overall, like, why would investors put their money in these kind of speculative, frothy companies? And he said one of the principal reasons why people hazard their funds in these so-called speculative stocks is that there are few instances where such ventures have proved highly profitable from the start, and the promoters are adept in stressing and emphasizing these exceptional cases.
Yeah.
So corporations load their prospectuses with figures showing the great profits that could have been made by buying Standard Oil or General Motors at ground floor prices, concluding with the confident predictions that their particular venture will duplicate these performances, which they never do. And so again, just like you use Amazon and Google in 1919, they're using Standard Oil and General Motors as examples of what someone promoting a company would say. We're in the same space, if you get in now, then you can get the same type of profits that investors that bought Standard Oil at the start got. And so, just stick with it, even if times get tough.
And it sounds more sophisticated, right? They don't sound as snake oily as they did back in the day, but it's still the same pitch. Which means that, by the way, this is where VC and retail are different, right? Because VCs know they're playing the probabilities, and they know even it can even get frothy there, but they're guessing that 90% of them will fail, and they're just looking for the one or two. That the problem with retail is that it's not that same calculus, and if it's not funny money that you don't need, or just casino money that you don't mind, but if it's your real savings, that it's much riskier proposition.
Yeah, exactly.
So what is a better thing to look at, right? What should we shouldn't be looking at, because some people say, oh, look, it's up, 20%, or it's down 20% from its high, but that doesn't matter, because that could have all been based on this speculative action, right?
Yeah. I can't remember what it is, but yeah, Bill Gurley had a great tweet about that, saying basically like the price action of the last 2 years, it should just be ignored. If something is like these high flying tech stocks, if it's down 20%, that doesn't mean it's now a great buy. It's not like a value stock suddenly,
right?
Just because it's down 20%, because it could have been up way past what it should have been over the last 2 years. And so I think just doing the kind of basic fundamentals of looking at the actual company's balance sheets, earnings reports, et cetera, and investing based off of the boring metrics and focusing on that instead of just buying into a narrative, which again, the narrative could be perfectly accurate and come to fruition, but don't just make an investment decision based off that. Just like in anticipation of a Fed decision, you shouldn't freak out based off of what you see other investors saying, or other like bearish sentiment. You kind of just essentially have to do your own research.
How do you think about that in terms of these brand new areas like the crypto area, where there is no track record? So in that case, it's hard to look at the earnings and fundamentals, but maybe it's just better to think about what kind of money or that you're investing in it. What do you need that money for? What your risk profile is, right?
Yeah. And I think that's just a very great answer for a lot of these questions is you can speculate all you want. If you want to go enter the Wild West of crypto, go for it. But I mean, obviously you should do research and make sure you understand what you're putting money into and understand the ecosystem in advance. But the lesson that you really got to stick to is just to not, suddenly go in as a newbie into crypto and invest like all of your investable assets and, other funds into it, and keep it to an amount that you can kind of withstand losing.
And you point out that there have been schemes since like the 19th century, right? Like and the names change, the players change, but what do you pump and dump schemes, insider trade?
Yeah.
I mean, these have been around forever, right?
Oh yeah, there have been those types of schemes since the 17th century in the Amsterdam Stock Exchange. There's no shortage of this similar every type of scam and fraud that exists in crypto today, that the kind of traditional financial media and institutions point to as examples of crypto being just a big like cesspool of fraud. All those things happened in the traditional markets that people consider the like esteemed institutions today, like stock exchanges and bond markets, et cetera. It's just happening in crypto at a much faster pace because of the technological capabilities that we have today, and regulations are happening faster. I mean, there wasn't any laws or regulations around insider trading until 1909, which is like just astounding to think of. I mean, in the 19th century, there were treasury secretaries at major corporations that were shorting their own stock. And it's just like, it's just a wild era. And so just understanding that type of maturity and or maturation and development of asset classes like equities and bonds happened too. You know, it's not unique to crypto that there was a lot of like fraud and there's a lot of sketchiness going on. And it's on its own path to kind of becoming a more developed and mature asset class. And I think regulation will help that. But yeah, to just view it as kind of just a permanently crazy cesspool of fraud is kind of ignorant, because all of those types of things happening today happened in equity markets for a long time.
So Jamie, how would we sort of sum things up? What kind of, parting thoughts would you like to leave people with, who are trying to look at history for some guide here?
I think looking at periods like 1920 are interesting. And the overall lesson I would give is, I've mentioned it on previous Real Vision appearances, is that using history as a kind of compass instead of a like GPS. And so again, like we said at the beginning of our conversation, we always want that kind of, all right, what should I read to perfectly understand today? Like, what is just kind of this crystal ball where if I understand this period or this previous recession, then things will play out exactly that way today. You'll never, using history, find like a perfect roadmap essentially, or GPS of how to navigate markets today. But if you study history more broadly and look at many recessions, many panics, crises, et cetera, then you can kind of pull out the major trends and themes, and use that as kind of a compass to at least point yourself in the right direction in markets today, and try and just orient yourself correctly. And so looking at periods like 1920, 21, at O'Shaughnessy Asset Management, one of our research team members put out an interesting piece on the great inflation of the 70s and comparing that to today, and how there are very many differences. And so that would be another one to read. But yeah, just looking at broader economic and financial history and major periods to see kind of what trends you see.
Fantastic. Jamie, we always love catching up with you. It's an important sort of, I think, lens for us to put on the current situation we're in. So thank you so much for doing a lot of that legwork for us.
No problem. Thank you for having me.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.